right, Rob, you ready to go?
I am.
You are. All right. Sounds good. Well, while there's others joining, we will get started here shortly. I want to welcome Rob Anderson here today. We're going to talk about Texas. So I'm a fan of Texas, and I want to hear more of the story about why Texas is the new gold rush. So we will get started here with Rob. Rob is the president of VV Capital, a private real estate equity firm based out of Dallas, Texas. He's also a principal in VV Securities, a wholly owned broker dealer offering direct investment opportunities to accredited investors and RIAs. Mr. Anderson has been investing in real estate since 2002 and is passionate about educating investors on investment and tax benefits of adding private real estate to their portfolios. He sold his portfolio of investment properties and now owns passive investments in multifamily, student housing, industrial, office, and land. So, Rob, I will make you co-host and turn it over to you.
Welcome, everybody. Rob Anderson, as Jim said. So I've been securities licensed since the 90s. I started my career selling financial products to the big shops on the street, Merrill Lynch and Morgan Stanley. And I had kind of a Jerry Maguire moment just to set the table for everybody. I realized I woke up when I'd always been investing in real estate. I mean, I read Kiyosaki's book 25 years ago, Rich Dad Poor Dad, like I'm sure many of us did. And I had a bunch of rentals and vacation rentals and things like that. And I was building my portfolio. And a lot of what happened was I woke up and realized I worked for a stock-based company. Prior to investing in these rentals, all my money was in the stock market. My income is derived on selling a stock market vehicle. My company made their profits on the stock market. I wasn't diversified at all. And so, that's when I started my personal search for getting into real estate. And this is back in the late 90s. And really haven't turned around since. And since I've left that profession entirely, and this is what I do full time now, is invest and develop properties and bring in others to need investment properties. So we are based in Texas. The conversation here is about why we're not leaving the state. Let me give you a quick overview on what we're going to do. So, who we are, I'm not going to spend a ton of time on that, but it's important, who you're talking to. I'm going to do a little brief talk about why commercial real estate is so important to have in your portfolio. I'm going to spend the majority of my time on the Texas economy and Texas real estate. That is kind of the focus for this. I have a lot of information. I'm going to squeeze into a short amount of time here. So bear with me. I'm going to have plenty of time for Q&A is my goal. So if I go past something, by all means, write it down and ask me, and we'll go ahead and get started here. Now, first off, this is not a solicitation to invest in anything. This is not an offer to sell you anything. That has to purely be done through a private placement memorandum. You need to fully read it, understand the risks, understand what you're doing before you move forward. And if you find something at a future date, we'll be happy to visit with you at that point. This is designed to be educational. So I just want to mention that. So who is BV? BV started Bridgeview Real Estate. That's what the BV stands for when you look at that. We're a vertically integrated firm. We're privately owned. We're veteran owned, actually. And what is vertically integrated? That gets thrown out a lot. It means we control most of what happens when it comes to doing a deal. So if you look, Bridgeview Real Estate is the parent company. We have Bridgeview Multifamily. We do a lot of multifamily. We do a lot of other things too, but that's kind of our development arm. Most notably, though, below that is Bridgeview Construction. We are our own GC, general contractor. Doesn't mean we have 1,000 employees because we're not doing any of the actual work. We have about 10 employees in there, but a lot of civil engineers, a lot of people that have construction experience, and their job is to manage the project. Because if you do not have your own general contractor in-house and you're hiring a third party, when prices go up, you just get a bill. Well, with us, when prices go up, we go bid it out in the open market and find somebody better to do it at a better price. And it allows you more control over what you're doing, because whether it's value add or whether it's ground up construction, you're going to need that construction company. The next one over you'll see is Lead Equity Group. It's the one that doesn't have a BV in the name. That is our property management company for multifamily. It is a joint venture. That's why it doesn't have the BV. We own 50% of it. So we actually have control. So we have in-house property management, and that's a key. And I'll tell you later, the only misses that we've ever had is when we had to deal with third-party property management. I'm a big proponent of in-house property management, whether you're dealing with us or somebody else. One of my keys that I tell people is make sure that they have in-house property management, because otherwise there's a lack of alignment there to what the goals are. BV Capital is Bridgeview's private equity and investor relations company. We're the ones that actually structure things and bring it to you. We're the ones that market. So if you're looking around, you're not going to see Bridgeview that often. You're going to see BV Capital. We're the one that spend the money on marketing to come visit with you. And we have a team of people designed to explain the information. Everybody's securities licensed here through our broker dealer. So we have to kind of hold ourselves to a higher level, which is actually what BV Securities is. That's the next logo on that slide. We are audited by FINRA every year. And so we have a much higher fiduciary status than just somebody who's developing or offering you the opportunity to invest with them. So if you know anything about FINRA, that's the financial regulatory body that oversees all broker dealers all the way up to Merrill Lynch and Goldman Sachs. I have to deal with that same body as well. They're a lot of fun, let me tell you. But it is important that we follow the letter of the law in everything that we do. So we went ahead and took that extra step. Moving on, what have we done? We've got about 700 investors right now that are accredited investors. They're high net worth investors. We have left the institutions. We started off with institutions, private equity, large family office, insurance companies, things like this. So in the numbers below, those investments are not accounted for. We've got about 127 million deployed right now in across 12 projects. We've since returned, in addition to that, we've already returned 33 million on past projects that we've recycled for an average project IRR of 38, and I'll show you that in a second. But this just gives you an idea of what we're doing. Our focus is on individual investors. Part of the reason I left the main Wall Street financial services business and went into this full time when I partnered up with my current partners in BV Capital is I hated that you didn't get the access to this like you used to. Now, thanks to the Jobs Act and a lot of things that have changed, it's now there, but we want that 700 to grow to 1,000. We want individuals to have the opportunity to do this, not just the 9-digit families that are out there that normally are who fund these type of projects. Here's a quick little overview on what we've done. It's a lot of multi-family on here. I'm not going to bore you with a lot of this. Just trying to let you guys know, this is actually dated. We have 20 properties under management now, not 15. So I got to yell at my marketing people now that I look at this slide. This is really the one that people like to look at. Just how have you done on the deals you've recycled? As you can tell, we started going around the country and then we stayed to Texas. We've done about 30 projects total, and I want to say 27 of them are in the state of Texas, and that's why that is our conversation today. We have project level IRRs here. We average 38. The investor IRR somewhere between 30 and 32 on this. We have a project multiple of 271. The investor multiple is around 2.3. Apologize that it's not on the slide. We've never lost investors' money. We've never had a capital call. We're very proud of that. We have missed pro forma twice. Why did we do that? Excuse me. The first was third-party property management. And we ended up, they dropped the ball so bad that we had to sue them. Got a mid 6-digit, I'm talking roughly $500,000 worth of settlement out of them. Due to the massive neglect. And I won't say the name because you'll know the name. It's a name that everybody uses, but they are not aligned with the developer and the investors. They're purely aligned at not losing that business. It's really a flawed model, if you will. We learned from that, and that's when we started our own property management in the JV that I mentioned earlier. The only other project that missed pro forma just slightly was a project down in Houston. And a little event down there called Hurricane Harvey hit. And what happened was we were supposed to sell that ground up construction in three years, and then we had to sell it in 4 years. But we still doubled investors' money. We were slightly below pro forma on that one. Nobody really gave us too much grief because they still made a good return. So that's just a quick bit on what we've done and what we're doing. Let me move on. This is a quick idea of the portfolio. The only reason I show you this is so you see that we own a lot more than just multifamily. We have industrial, we have office, we have triple net. What we're focused on is not what you'll see is a lot of folks that you'll talk to do one thing and they do it across the entire country. We are kind of the exact opposite. We do multiple things in one geographic area, the state of Texas, because real estate is location, 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 and you've got to have the networks built locally to get off-market deals. The best deals you can get are off-market. How do you do that? You dig deep networking in your local markets. If you're across the country doing the same thing, rinse and repeat, that's hard to do. So we're a very opportunistic investor, if you will, when we look at what we're doing. Okay, so let's get into a little bit for real estate. I'm going to go fast on this because I think most everyone on the call is aware of this. Where are the big money putting where are the big pockets of money out there investing? And as you can see, alternative assets have grown considerably over the years. Unfortunately, this is only through 2019, but you can see the upward trend of alternative assets. Real estate is still considered an alternative asset. It is the largest percentage that is made up of those alternative assets, followed by private equity. And then you've got other things like gold and crypto and other things that are happening down the path. But always follow where the largest people go, the endowments and the largest, CalPERS and the Yale Endowment and things like that. Where do the biggest, most seasoned investors go? It's a good place to follow. And as you can see, they're adding to their real estate allocations. Now, inflation. I know CPA came in a little bit lower, finally, thank God. But inflation's still an issue. So this is a neat chart to show you the 3 times that we've had inflation and what worked, right? And so what we're looking at here is commodities, gold, and REITs. Private real estate's not really tracked, but REITs are, so it's a little off. 73 to 79, what the best thing to own was gold. Well, that was a unique time frame. We were just coming off the gold standard at that time, and so gold became its own individual asset class. Excuse me. And so that was kind of a unique once in a moment time frame. As you can see from the other 2 time frames, gold did not help you one bit. If you go to the next time frame, you'll see that real estate was the best way to go. And then the other time frame, it was commodities. Commodities is generally driven by oil and gas. The key here is, what is the steady eddy across all 3 of these? Real estate. Real estate is a great place to be when you're in an inflationary environment like we've never seen before. And I hope it goes away, but I'm not too convinced it's going to go away quickly. And so I just like to point this out for folks. Okay, now where do you put real estate in a portfolio? Keep in mind, I love this because of my background in the financial services. People are always trying to find the efficient frontier and how do I allocate and all this stuff. And people are going, where's real estate fall? It falls in between stocks and bonds. It really does. So you've got almost the, this is a great chart because you get about the same returns historically as you do in the stock market with a little bit more risk than you find in the bond market. It's a beautiful in between there. If you look at the way this falls out. Now, this is broad brush. It's national. It's not Texas. It's everywhere. It's a diversification of REITs is where they get this. Our returns, as you've seen, are much higher, but it just overall gives you kind of a nice feel for where the stuff falls. Now, once again, real estate compared to the stock market. I know I'm bashing the stock market. I still got money in the stock market, but look at the S&P. It's down considerably year to date. And then look at all the different asset classes across the board. You got industrial, storage, multifamily, office, hotel, and retail. And you can't just look at a snapshot in time. That's why I like this slide. If you look at last year, the S&P did really good. Well, real estate did pretty good too. But then look at this year, the market's down. Real estate's still doing well. So it has kind of become a key component, and it should become a key component of everybody's portfolio. Last slide, and I'll get into Texas, is if you invested $1 million 20 years ago and you put it in the S&P 500, where would you have ended up versus, excuse me, if you had diversified it across a broad basket of the REITs on the market through commercial real estate, you'd have done 2.5% times better on a compound annual growth rate. So it is considerable what investing in real estate, and I would argue private real estate, can do to your portfolio. Okay, so let's move on to why you guys all tuned into this, because I spent some time on that. So why are we investing in Texas real estate? And you have to forgive me, I'm being a little bit of a homer here, but I'm also trying to illustrate the economic statistics of why we're doing this and why you might want to look at it in your portfolio too. And well, right off the bat, if you have job growth and you have population growth, you're going to do really well in real estate. We've got a little bit more than that. We've got a little bit more headwinds than that if you look at the slide. We've got job growth, corporate relocations, population, GDP growth, exports, and as you know, there's no state income tax in Texas. So this is kind of going to be the basis for what we're going to go through here. Number one, job creator. U.S. Bureau of Labor Statistics. I know it shows a job site there with Shell Oil, which U.S. headquarters is in Texas, but what you're going to see through this presentation is the state is much, much more diversified than you may think. Down below, number one destinations for company relocations, the Dallas Fed. That's a building going up in the Dallas area. Number one population through the U.S. Census in 2020. That is the Pearl distributor, beer distributor over in San Antonio. They've completely redone it. It's a really neat place that people like to go hang out at. Number one for GDP growth, U.S. Bureau of Economic Analysis. That picture down at the bottom is on Louisiana Street in downtown Houston, staring upwards at the skyscrapers down there. They call it Energy Alley because that's where all the big oil and big natural gas companies are based, all in those buildings down there. It's kind of an interesting view. Number one exporter in the US, and it's not just oil and gas. It's a lot of manufacturing. There's a lot of onshoring happening right now. You've probably read about this. And we have no state income tax. So if you invest in a deal that is in Texas, you do not have to fill out a state income tax because we don't even have it. We wouldn't know how to help you do it because there isn't one. You don't have to worry about that. That is a neat thing that we can offer here. So this is also kind of a summary slide. There is a lot of information on this. I don't expect you to look at it, but I'm going to take pieces of this through the rest of this presentation and walk you through all the different reasons that things have happened here locally that have benefited the economy, which then in turn benefits real estate investors, because that's really the purpose of this conversation. 10th largest economy in the world. If the state were a country, we bounce between 9 and 10. We kind of go back flip-flop with Brazil. It's really interesting how that works, but larger than South Korea, larger than Canada, larger than Russia, larger than quite a few others. I know California's had their little argument there, and they are still a little bit bigger than us, but the growth rates is really where you want to be, and that's what Texas has. So kind of a neat overall slide for you. Let me move on. Okay, why is that? Well, the job market. You know, as you can see in 21, we added almost 700,000 jobs. And so when you have a growing job market, you're going to have a growing real estate market. So then the question is, well, what's going on? Look at this slide. So from 2009 to 2019, the state of Texas grew its job market by 22.3%, where the U.S. was at 13.7. It was at about 9%, almost 10% more in that time frame. That is significant. That adds up over time. So as you can see, the job growth is not a moment in time. This has been going on for a while. So it's been snowballing for a while. And that's the beauty of what's going on here. Why is that? Well, if you interview CEOs, they'll tell you that Texas is the #1 place to do business. So why do we have so many companies moving here? The CEOs want to move here. And I'm going to get into that. It's a lot of business climate, but this is a CEO ranking from Chief Executive Magazine. As you can see, Texas was ranked #1. A lot of the excuse me, a lot of the typical states you'll see following us there. And a lot of this is purely based on the business climate. How easy is it to do business there? How easy is it to grow there? I'm going to show you a few more stats as we move on. And it's been proven. So we now have 43 of the Fortune 500 companies are now headquartered in Texas. We have more Fortune 500 headquarters in Texas than any other state. If you look at this, there's a lot of logos on here. And the thing that I like to point out, obviously we have a lot of the oil and gas here, but we have a lot of everything else. There's tech, there's airlines, there's health, there's financial firms. There's a lot of different things here. There's a lot in Dallas-Fort Worth. There's a lot in Houston. Some pretty famous names are over there in San Antonio and Austin, as you can see. And you're going to hear me talk about the Texas Triangle. The Texas Triangle goes from Dallas-Fort Worth down to San Antonio, over to Houston, back up. If you follow the roadways there, that is the powerhouse in Texas. They call it the Texas Triangle because that is where 70 to 80% of the population, the jobs, the GDP is all on that Texas Triangle, back and forth, back and forth. Okay, one thing you may not know is it's not just oil and gas. Texas is now #1 in semiconductors. There is a giant plant coming outside of Austin by Samsung. It might be the largest in the country. When they're done, it's going to take 10 years to build. So you've probably heard of Silicon Valley. We have what's called Silicon Hills in the Texas Hill Country, which is the greater Austin area. And Austin is now the 2nd largest tech hub in the country. So just to go back a little bit here for you, if you look at the map, Dallas-Fort Worth is where most, if not, it's a very executive-driven market. A lot of companies are based there. A lot of headquarters are based there. It's a very diversified market. It's a very, I'd say, executive-based market. A lot of financial firms there. You go to Austin, you got tech, right? And then you go down to Houston, you've got oil and gas, and then you've got medical. And so they kind of all come together to give you a diversification in the state. This is a really interesting slide. If you look at it, oil and gas isn't actually propelling the state. Because, I mean, if you can see what happened in 2020, the rig count just basically fell off the map. And so considering where we are with gas prices right now, I figured the audience might find this interesting. It really doesn't have a lot to do with oil and gas. It's just more global macro. As you can see, the rig count is still not back to where it was. And it takes a while for that rig count to get up there and eventually catch up with the price of oil. And then they will invert, which hopefully someday will happen, and the price of the pump will go back down. My point is there's still a lot of run room left on this. And that just further benefits the state as that industry continues to grow, because it is still a major industry around the world. And the growing one that you're going to see on the Texas coast, I'll talk about later, is actually LNG. There's a global issue, especially in Europe, where they need natural gas and they don't have a way to get it because of everything going on over there. And we're starting to have massive exports coming out of the Texas coast of liquefied natural gas. So that's an interesting sort of shift that's happened recently here. So where's everybody coming from? They're coming from everywhere. Here's a neat little map that shows where everybody's coming from. Look at the number of companies that have moved to just the DFW area alone. DFW is Dallas-Fort Worth. Over the last decade. It's a lot, and they're from everywhere. Allied, who's a big mover, right? Texas #1 in corporate destinations 6 years in a row. Here's a couple of the more famous names. CBRE, real estate company. Charles Schwab has their headquarters here now. Hewlett-Packard came to Houston. Oracle went to Austin. AECOM went to Dallas. Caterpillar went to Houston. Tesla is obviously in Austin. SpaceX is in Texas as well. And it's amazing the amount of business. So when you have this much business coming to an area, you have, there's a trickle effect, right? We have way more people than we can house. We do not have enough warehouse space for all the goods that are running through here. We don't have enough retail. I mean, I could go on and on. We don't have enough grocery. I mean, where I live, we just opened 2 new grocery stores. It's amazing when you have this many people move, the trickle effect it has, especially in real estate. So there's a joke that we always say, I wasn't born in Texas, so I got here as fast as I could. And so yeah, we're seeing that a lot. It's estimated that we'll have over 45 million in 2040. We have just a hair under 30 million today. So that's a massive increase. So if U-Haul does a growth index, if you're not familiar, it's really neat. They just simply look, if you look at the text down below, they look at one-way trucks. You know, how many one-way trucks are going this direction versus this direction? They look at the net, and it gives them a really good indicator of migration trends. Migration trends are very important in real estate. And as you can see, Texas has been #1. We've been #1 for a while with one-way moves, and that tells you people are moving into the state much more than they're moving out of the state. And so that's something you're going to see if you look at a lot of the statistics. So where are they coming from? They're coming from everywhere. Now, we get a lot from the West Coast, but they're coming pretty much from everywhere. This is a neat chart. I think this is 2020, so forgive me, it's hard to get, 21, 22 data. It just takes a while for it to get through here. The Texas Real Estate Research Center, Texas A&M University, does a lot of neat statistics. You'll see a lot of the stuff that we use is from there. Our own founder has a PhD in economics from A&M. We look, as you can tell, we look at the global macro when we do things because we want to have some headwinds at our backs. Definitely helps an investment, helps our investors, but we're getting people from all over. If you look at this, and even CNBC is showing it, the great migration that's coming out of California is a real thing. And it's moving this direction. And we're getting a lot of folks that have sold houses they bought for 400 and they sell it for 3 million, and they come here and they put half of that into a massive house. They got a lot of money to invest, and it usually stays locally. It's really interesting what's happening here. This trend is not stopping anytime soon. We don't see. Moving on, exports. So #1 exporter for 20 years in a row. Our ports, we have the #1 and #3 ports in the country. The exporting is growing right now. I don't mean just container stuff. A lot of the container stuff's in California. I'm talking about just everything, cars, liquefied natural gas. I talked about that earlier. Just the exporting that is coming through the state is a huge benefit to the state. And we are the #1 exporter in the country. People a lot of times think California or New York. Texas actually dwarfs those numbers because we have so many ports. We have a lot of deep water ports. And what's interesting, I bring this up a lot, all the natural gas lines in the country all come down to the Texas and Louisiana port. I should have put the map up here to show you all, but I didn't. If you look at a country and you look at a map of all the natural gas lines in the country, they all pretty much come through, a lot of them come through Oklahoma and one other terminal, and then they all funnel down to the Texas and Louisiana coastline, and that's where all the export for the LNG is going. And that's going to be big, big business going forward, in addition to everything else that goes through the ports. And actually, Galveston is one of the top cruise ports in the country nowadays, which is just south of Houston. So we're actually kind of expanding there a little bit. Why is the business climate so good besides having no income tax? So this is a neat one you can look at from this website I put down here. Cheapest state to run a business. It's also the #1 state to start a business. I spared you guys that one. But what they did is they looked at annual wage, tax income, corporate income tax, average electricity price, average internet price. The cost to live here is still so low. The cost to do business here is still so low. It's comparable with states like Oklahoma and Kentucky. Nothing against Oklahoma and Kentucky, but they don't have near the firepower that something the size of Texas has. So if you have the firepower we have at the cost that is so low compared to some of these other states, as you can see, we kind of have an unfair advantage. And when companies do the numbers, they can add 10% to the bottom line purely by moving from where they are to here. And that's why you're seeing so many people move here. Obviously, we have no state income tax. But what's interesting, though, people may not realize is we're very landlord friendly. We have very good real estate laws for landlords, very pro-business environment. We have a relatively quick foreclosure process as compared to the rest of the country. We all know what happened in COVID. We own several thousand doors ourselves in multifamily. We don't keep them. We usually will sell them. So at one given time, the number doesn't get too big. So we want to pay investors out. But we still have a lot. And our justice of the peace were very accommodating. Now, if somebody's got a specific issue, we'll never throw somebody out. But if they are trying to take advantage of the system, we are going to encourage them to take shelter elsewhere. And the laws here are very beneficial in that realm to help us do that. So I like to point that out. So why is it such a big deal? I talked a lot about people moving from California to Texas, but the analogy is legitimate. In California, back in the 60s and 70s, they started running out of developable land. That's happening here in Texas. You go, well, Texas has got land out the wazoo. You got all kinds of land. What do I mean? I mean easily developable land with utilities. If you do not have land with utilities, it takes time to get the utilities there. That creates a backlog. Texas just hit that overall statewide. California hit that in the 60s and 70s. And that is why their real estate values started shooting through the roof from that point forward. Well, what's happening is we have the same thing, because if you think about it, everybody's moving to California back then. And then they did for several decades. And if you look at what real estate did in California, boy, was that a good time to invest. We have that happening here in Texas. And that is really the thesis of everything I'm showing you right here. Looks like I have two different decades on here. It looks like down below 70s and 80s. It's actually 60s and 70s. So forgive me for that typo. If you look at the 60s and 70s in California, it is very comparable to what's happening here in Texas, purely because the easily developable land is gone. Now cities and municipalities have to spend money to get the infrastructure put in outer and outer and outer bands. What that does is that creates a lag in time to develop. It also creates expense. You have something that is known as impact fees. Impact fees are the fees that the local municipality will charge you to develop there. And that is used to offset the cost to bring in the utilities. Well, what's happening is impact fees are starting to go up, and up because we ran out of land, and they can't just, run a line and it's done. No, they got to put in a water treatment plant. They got to get, gas, they got to get electricity, they got to get roads, they got to get stuff out there. That costs money. And so what you're going to see is the impact fees are starting to go up. And so you got to have somebody on the ground that knows the different markets and where to go and where not to go and when. We just had 2 deals that we were able to get in prior to impact fees going up. The beauty of that is the people after us have the exact same deal as us possibly, but that's going to cost them $3 to $4 million more on their project than we are, because we got in prior to that. So knowing the local market is never been more important because of this particular issue. Industrial, we love industrial, we love warehouses, and it's kind of neat. People don't realize how big of an industrial market Texas is. So this is from CoStar in July of 2022. Look at this. We had 3 of the top 10 markets in the country. Houston, DFW, Austin, San Antonio. Now this is a snapshot in time. If you look at the industrial markets in the country, DFW is actually number 4. Excuse me, Chicago, LA, and there's a spot just outside the Pennsylvania, New York area that are the top 3, but we're growing the fastest. And as you can see, Houston actually grew the fastest last year. It's really interesting. The Houston port is exploding right now, and Austin's doing well. San Antonio is doing well. So there's a lot of activity, not just in housing, but in industrial. For every million new people, for every 1,000 new people that move into an area, you need an additional 1.2 million of warehousing space. I mean, ask Amazon. They've got these numbers down in that the amount, it's purely based on in-migration, which you can tell is what I've been talking a lot about. It is a trickle-down effect to a lot of other things. Okay, this was taken from a video, so forgive me for the cutouts, but this is a great example to show you one of the other advantages that we have is location. So we can get anywhere in a very short amount of time. LA, 3 hours, New York, a little over 3 hours, Chicago, under 2 hours, Portland, a little over 3 hours, Miami, 2 hours, Phoenix, 2 hours, Atlanta, 2 hours, etc. As you can see, we can get across the country. That location is a big advantage, especially when you're doing business around the country and you're looking at where you want to relocate. The location has been a big advantage for us. So I always like to point that out. Kind of a neat way to look at it. Okay, so let me start wrapping up. Where are we? We're all over the state. You can kind of see from the dots. We've got a lot of stuff. We got a lot in DFW, a lot in Houston. Those are the two powerhouses of the state. San Antonio, Austin is a great booming area as well. And there's some other opportunities out there. I've been talking for a while, so let me kind of scoop this up. This just gives you an idea, so you can kind of see some of the dots of some of the stuff. We've sold some stuff. We still have some stuff. This is office. This is medical. This is multifamily. This is industrial. Some of this is land. Some of this is mixed use. It just depends on what the best use or opportunity is in that particular spot. This will give you a good idea. So we've got some stuff in Dallas. That LBG Tower is where we office. We own our own office building. We've developed some stuff. There's a new one that's further north that's not on this list. We've got some neat stuff in Fort Worth. We've got some industrial, some multifamily, some student housing, some medical office. Arlington kind of gets thrown into Fort Worth, but Arlington could really be considered its own market altogether. We've done a lot down in Houston. Houston's been a really good market for us. So a lot of these have been sold. A lot of these are ground up multifamily or value add multifamily. We still have some of them. We have some triple net product down here, as well as some industrial down by the port. Just because of that growth that we've seen. This is some stuff out in El Paso. There's a million people in El Paso. People don't realize that. Millsap looks like it's in the middle of nowhere. It's just outside of Fort Worth. New Braunfels, Austin. This is San Antonio, Austin. The San Antonio, Austin corridor is massive right now. Austin's gotten so expensive that a lot of people are moving out. And what you're going to see is the surrounding ring of greater Austin is where you're going to see most of the growth. Purely due to the institutions owning downtown Austin and driving up the price point so much. So it's really fascinating what we're going to see there. That corridor in between San Antonio and Austin, there's a freeway there called I-35. That is an incredibly hot corridor. If you guys are looking at a deal up and down that corridor, take a second look. It's probably going to do well. We're big fans of that corridor. We also have some stuff on the coast. Galveston and Corpus Christi. Galveston is a vacation home development. The Corpus Christi is taking advantage of the LNG supply lines that are all going down there. Corpus is a massive exporter of LNG. We see population boom happening down there. We want to take advantage of it. So what do? We do a lot of stuff. We do stabilized net lease product where you can clip a coupon. We do value add. So the first one is a property we own in Houston. The next one is a student housing we have in Fort Worth. Where you can kind of see, typical value add renovation there. And then we do a lot of ground up. There's a lot of profits still to be made in ground up construction if you know what you're doing. The value add play in Texas is really hard to do nowadays because cap rates have compressed so much and values are so high. However, you can get good land. And if you can work with the municipalities, ground up construction is a great way to go. Now, you don't get income along the way, but when that thing does sell, you're pretty happy with yourself. So that's a neat thing. We are about 6, maybe 7 years behind in building for units in the state of Texas, single family and multifamily. So I mean, there's a demand there that's just not going to go away. So we're obviously bullish on Texas. That is the end of my prepared remarks. As you can tell, we do a lot of different asset classes. We offer different ways of doing things. And I'm going to go ahead and stop here, Ryan, if there's questions, and hopefully I didn't go too far over. And this is how you guys can get a hold of us.
No, you're good. Great presentation, Rob. If anybody has any questions, I see we've got 1 or 2 in the chat there. And Rob, since I handed over hosting abilities to you, I think you'll have them. I'll go ahead and read them for you to help you out there. Second question is, Rob, what's the best way to contact you? You perfectly hit that question here with the last slide. Sophie's other question was, what is your take on short-term rental RV resorts as an asset class or as asset classes? And does your company plan to get into that space, of course, in Texas?
I think it's a good asset class. We don't do that. So I'm not the best person to ask about that. Now, RV resorts is obviously a lifestyle type investment. It's very low overhead. So, I mean, that's a good thing. And if you know how to operate it, go for it. I'm not your guy. And so I'm just going to know my lane. That's not what we do. I've owned an RV before, so I fully understand it. I'm not really going to be the best to answer that question. I apologize. I don't want to go give you an answer just to give you an answer. And it's not something that we do.
Great. Again, just throw your questions in the chat or come off mute if you want to ask Dan a couple questions. I've got a couple just here. You answered a lot of my questions that I was kind of jotting down along the way. One question I would have is, given the economic conditions that we're in right now, what do you like best or see the most opportunity in here in the next 6 to 12 months as things start to level out, or we see where we're headed?
We like ground up construction. I don't know if you noticed the 10-year just dropped down to 3.8. I mean, it had a significant fall today. So obviously financing is a concern, but here's why we like ground up construction. It's a short window, and you can do interest only. So when you do a ground up construction deal, you only need financing for, call it, 2 to 3 years. You can build something if you do it correctly, get it fully stabilized, and then exit. And we actually exit to the DST space. I didn't mention that earlier, but we're getting pretty heavy into 1031 DST space for exchange people. But you can sell to an institution or sell to a DST in ballpark 3 years. Well, the interest burden in that time frame is nothing compared to the margin you can make in the ground up construction space. So as far as the global the national economy, that's why I hopefully made the point. We're fairly insulated down south here. And so if we hit recession nationally, we don't hit recession in Texas, we'll have a cold. And so what's going to happen is we still have the supply and demand issues of everybody moving here, companies moving here. Just because we have a slowdown nationally doesn't offset the fact that the whole world got up and moved to Texas and we're undersupplied in all the things that I just talked about. If that makes sense.
Yep, absolutely. One thing we've seen too in different investments that we've made or heard throughout our community is, especially this year, is the backlog in the eviction courts and kind of where that has caused some issues too. Have you guys seen any of that? And it seems to be lessening right now, but what's your take on that issue in particular for Texas?
This is one of those points where, thank God we live in Texas. We don't have those issues as much. We're not perfect. Nobody is. But the justice of the peace. So if you go back to COVID, let me go back and give you a little story, Ryan. Back in COVID, you had this moratorium, right? Well, then Texas passed a law that said, okay, you can have the moratorium, but you have to prove that you've exhausted all other avenues. And so what we would do is we put somebody say, okay, you've gone 6 months. We know you're still working. You're just refusing to pay us. We actually had those situations. Because we actually had somebody come to us and say, I don't have to pay you. I'm not going to pay you. I'm like, you're going to ruin your credit, idiot. Don't do that. So we put them in front of the justice of the peace. Justice of the peace to prove that you tried to exhaust all other avenues, and they can't do it. So what I would say is it's a very landlord friendly state. It's not opposed. It's not as if they're mean to these folks, but you can't just be a squatter. You just can't. And after a certain amount of time, we are very successful in encouraging people to find shelter elsewhere.
Makes sense. Makes sense. Peter has a question specific to BV. What current deals are offered by BV? Do you have any currently, or what do you have in your pipeline?
Yeah, we've got a fair amount that's about to come out. So I was kind of instructed not to get into deals. So forgive me for not doing that.
Sure. So I guess as succinctly as you can answer your question.
I mean, I love the question now. Yeah. That's why we're here. We want to work with you guys. So we do 3 main things mostly. We'll do net lease. So we have a net lease fund that is industrial and commercial across the state of Texas. It pays, that is still open, pays a 7% annualized coupon. It pays monthly. It's much lower on the risk return schedule, right? And so because these are triple net leases, there's not a lot of so-called risk to them because there's not construction risk. You don't have renovation risk. I mean, these are contracts with large companies that are just paying income. That's a neat one that's open. We just closed a DST, a Delaware Statutory Trust, which is a 1031 vehicle that's closing right now. And we just closed out on a land deal where we give investors a pretty high preferred return to help us take down some land in pre-development. In 2023, we're going to have 1 to 2 land deals come out. We're going to have a very busy first quarter. So if you guys like what we're talking about, please, follow us online or go to our websites and send us a note so we can put you in our database, because we're going to probably have 4 or 5 deals come out just in the first quarter. In the first 6 months of the year, we have 5 ground up construction deals that we're going to launch that we've been working on for the past 9 to 12 months. And these are multifamily, primarily. The industrial, the net lease fund is a lot of industrial. So if you want to diversify from multifamily, a lot of folks will go into that with a little bit just to diversify property types. But the ground up stuff that we're doing is multifamily and mixed use. You may see some office hotel, believe it or not, come back here next year from us as well.
Yeah, great. And I see Dan did a good job. Thanks, Dan, for linking that to the investment offerings in the website. So I appreciate that, Dan. George's question, are property taxes too high in Texas? If so, what is the impact on future returns?
We sue every year. And people, you may not know this, but if you contest your property taxes on the single family home, you just kind of hire somebody or do it yourself. In the commercial world, you actually hire a law firm and you sue the city or the county or whoever you're trying to get your taxes down from. And we sue every single year on every single property. So the one knock that people will put on Texas is, oh, your property taxes are higher than other places. Well, that's because we have 0 state income tax. If you factor everything in, we're still so far below everything else that goes into it. If the numbers didn't pencil, we wouldn't do the deal. And right now, they are not affecting our ability to do a deal one bit, is what I would tell you.
Okay. Okay, we have one more question in here. Where is your headquarters? I think you answered that question, but if you want to touch on that again real quick.
Yeah, we're in Dallas. So we have partners around the state, but our headquarters is in Dallas. If you're familiar with Dallas, we're at I-75 and LBJ Freeway right at the corner there. So we're pretty centrally located. We bought a 10-story office building. We've been renovating. So, free rent, that doesn't hurt.
There you go. Next, a couple things that stood out to me while we're waiting for another question. A couple things that stood out to me. I mean, I like Texas. I invest in Texas, but the U-Haul rate wasn't necessarily surprising to me, but the projected growth through 2040 was shocking to me, as well as the export stats. I did not know Texas was the #1 exporter. Do you see? You mentioned Corpus Christi and Galveston, but are you guys looking at coastal opportunities there with that? I mean, it's been decades running that you've got that export stat. So what do you see, or are you looking more so on those coastal opportunities there?
Yeah, and exports isn't just the ports. The airports are rather large. DFW is one of the largest in the country. I know Atlanta, I think it's the biggest. But if you fly into Dallas and you look at all of the football field size rooftops, those are these 1 million square foot industrial buildings that are near the airport. I mean, there's hundreds of them. They're massive. And that is a lot of the exporting that's happening as well. A lot of it is the location in the country, right? But the ports are huge. You notice that we bought an industrial property down by the Port of Houston. We have that property down in Corpus, and one reason we like it is the growth in the port down there. So the answer is yes, absolutely. It's got to be on a case-by-case basis, right? That's one factor. I've got to have other factors. Like, for example, if I can build something at $100 and call it $60,000 a door, and I know that I can sell that in 3 years for $260,000 a door, I don't care what other factors are involved. I'm going to go buy that dirt. And that's what's happening right now.
Good point. And then one of the things you mentioned too, and it was a thought I had of, seems like you could build forever in Texas. And you made the point of why it's not necessarily developable land. Do you see, is any one municipality starting to be more aggressive in developing that land so that they can build and grow, continue to grow, or anyone lagging in particular for being aggressive on infrastructure there?
Dallas and Houston are the most, Dallas, Fort Worth, and Houston are the most forward thinking. when it comes to developing the infrastructure outward. Austin's a challenge. Austin has terrain. It's pretty, right? They got big hills. It makes it difficult. And so that's why I mentioned the outskirts of it. The problem is what's happening is you're outgrowing the bigger cities. The bigger cities have their act down. Once you get to the smaller cities, they're not used to being boom towns. They don't have the infrastructure in place. They don't have the people. They don't have the processes to a certain degree. And so, we've got a really cool development in one of those cities I showed you, and it's delayed by about 6 months. It's been a little frustrating. It's going to be a gorgeous development. We're going to make a lot of money on it. But because of these issues, there is a delay. So you got to have a little patience. If you remember my initial slide, Ryan, I showed about a 3-year average turn. Sadly, that's going to get extended. That average turn is, I think investors need to realize that average turn is going to get extended by maybe 6 to 12 months. And that's not just here, that's everywhere. Due to the backlogs and things. You can still make very good returns, and I would argue some of the best returns in investing in real estate. But I think that the difference is we got to be a little bit more patient because there's some of these circumstances that are out of our control. On the flip side, it's going to force property values even higher.
Yeah. We have a new question from Sophie. What is your average LTV in your triple net lease fund versus ground up development deals?
It's very different. Yeah, that's a good question, actually. The net lease fund's averaging around 50% LTV. In fact, our last asset, we bought a distribution facility with Granger, and in Arlington, we had to buy that all cash. Now that rates are coming down, we can probably bundle some stuff and see if we can refinance something. But everything's got long-term debt prior, so we were fine. The multifamily, you can get 80-85%. Leverage is valuable when you're doing construction. Now, if you're going to hold it long-term, that's a different story. Our Delaware Statutory Trust business, or DST business that you would 1031 into, that averages about 50% LTV. In fact, our last one was 53 because you have to exchange your equity and your debt if you're familiar with that. So I would say the net lease stuff is going to be, 50, 55. By the time we sell, it'll be in the 40s due to amortization. The DST world is going to be around 50. And then our construction stuff is 80, 85. We're HUD approved. I'll give you an example. So our last construction deal, we got a HUD loan, 37-year amortization below 3%. Now, I can't get that anymore, but they're still at 5. They're still below market. And the reason is they're the government. And if they're a pain to deal with, so most people won't do it. We've kind of gotten through the painful parts. We know how to work with them, and it gives you an advantage when you're putting debt in place.
Good. Great. Thanks, Dan, for putting that additional content in there for the question. Any other questions that we have for Rob this morning? Throw them in the chat. Rob, I really appreciate your time. You did a great job of why Texas. I think a lot of us kind of know intuitively that Texas is a growth market and some of the whys, but the data you were able to provide behind there was more than I had known or realized too. There's a long runway, and so I see why Texas is a focus, and you made that point very well. So
don't let the national headlines don't put the national headlines on local markets. Right. That's what I would advise everybody. Everybody's different.
What kind of a little bit of a transition? What are you've touched on this a couple points, but going back to the LTV question, what are you guys doing strategically right now with debt as opposed to maybe 6, 8, 9 months ago? You mentioned all cash, lower LTVs. What are you guys doing strategically right now with debt as opposed to earlier this year, maybe?
Well, earlier this year, we were buying caps. I mentioned the DST we just finished. We bought $1 million cap, but it kept us at 590 where the market's at 7. So that was a good move. What we've done is when we go buy land, this is a little unique. Maybe you haven't seen this before. We're instead of just buying the land ourselves or putting debt on it, because there's only so much debt that you want to handle at one time. We're offering it to investors. And am I allowed to give you numbers, or do you? I don't want to cross any boundaries here, but basically we're giving people a 20% preferred return to borrow their money to take down the debt and do the pre-development work. So I'm not putting any debt on that. I'm using investor money to buy the land, capitalize the pre-development work. And then we buy them out with the development deal. The development deal is where the debt is. And so the development deal is a short-term deal. Those are easier to do. I already have permitted land that we own that can go into it as a contribution, and it gives me better terms. I don't know if I explained that well or not. And then the land investors can take their money and run when we buy them out, or they can convert in on a deferred basis. And so they get a compounding effect. A lot of people have liked that. So what we've done is we've quit putting debt on land that we want to invest or develop. We've bought it all cash with investor money is one thing that we've done differently.
Okay, great point. We're coming up on the hour, so I'll give one last chance for questions. But Rob, anything that you want to add to the presentation, or any points you want to reemphasize before we close it down for today?
Well, first off, thanks for having me, of course. But Ryan, this trend is not changing. We have probably a 5 to 10 year run, is what we think, and we fully believe in that. We've not seen anything that has changed that thought process. You can't just solve this overnight, this undersupply. This is purely a supply and demand issue. It doesn't go away overnight. The Fed can't get rid of it. It's still there, and you can still capitalize on it. And that's what we're going to do for the next 5 to 10 years.
All right. Great closing comments, Rob. We will go ahead and wrap it up for today. Thank you, everyone who joined for Rob's presentation. Thanks, Dan, for throwing the comments or the links up in the chat box, and Rob for having your contact information up there on the screen too. So with that, we will close it down, and thanks again for joining us today. Thanks, Rob.
Sure, thank you.